is clearly on the bulls. Yes, we broke the 200-day moving average for the S&P. Keep in mind the next one up, and the big one would be the NASDAQ. We're only about 100 above that. That's important to watch. But I think the February 9th low of 25.32 in the S&P, that's in jeopardy. This is an ugly way to start the first day of the second quarter.
Certainly. Kevin O'Leary, NASDAQ's down 200 points as we speak. As Joe said, I mean, there's no indication that anything is ready to pick up the slack from tech, and tech's rollover remains the biggest story in the market.
I think those that outperform this year will start to take some bets on other sectors. The one I'm eyeing is energy. Oil prices are holding up, yet you see no sign of life in the energy index yet. Could be an interesting play. My take on this is with 14% of the S&P weighted to the FANG stocks, which everybody assumed could never, ever correct on a PE basis. Now, whether all of a sudden you wake up in the morning, and let's just take a stock out of FANG, but I love to bash Tesla whenever I can, and this is a great opportunity. Apparently, this is the first time in the last 6 weeks where people say, oh, it has 4 wheels. It could be a car company. My goodness, if it's a car company, why is it trading in a stratospheric price, PE? And I think now that factor. I know people are saying, oh, it's got to finance, it's got to do debt, it's got to do equity. How about forget all that? How about it's a car company, it's got to trade on the same planet with the rest of the car companies? Guess what? They make electrical cars too. And by the way, I just bought the product. I would never buy the stock.
So, Weiss, I mean, you've got a plethora of news that you could certainly say is responsible for the sell-off, right? China comes out and tries to smack us back and puts on tariffs in its own right. Mm-hmm. You've got the continued fallout on Facebook. You got the president attacking Amazon yet again. And you can't get any the Tesla stuff that Kevin just mentioned. You can't get any traction on a number of areas where people continue to think they're going to rebound and carry the market's water again.
Right. So I think what it points out, if you sum it up one way, it's that momentum cuts both ways.
Yes.
So we've only seen upside momentum for the last 10 years. And now we're seeing downside. I don't expect to see down 10 years, down momentum for 10 years, but it generally goes down quicker than it goes up in most cases. To me, this is reminiscent of 87. I think we've made that observation before in terms of we had these massive moves in the market, huge volatility, and eventually it doesn't take a lot to have people really, say, hey, I just can't take it anymore. So you've had a lot of profits made over the last 10 years, owing mostly to low rates, an accommodative Fed, accommodative ECB, and now it's going the other way. So why not, this is the thinking of investors, why not take that money off, be happy with the profits, and you'll come back and revisit when things calm down.